Good morning. What is debt yield? So, in commercial real estate or CRE lending, few metrics carry as much weight as debt yield. Now, whether you're an investor seeking financing or a broker structuring deals, understanding this metric is essential. Lenders rely on it to gauge the true risk of a loan, independent of market volatility or property appraisals. And debt yield is a measure of property's net operating income relative to the total loan amount. So it shows how quickly a lender can recoup their investment if they were to take back ownership of the property. And here's a simple formula to help you calculate that. But debt yield, it's pretty simple. It's your net operating income divided by your loan amount. So let's give you an example here. So if a property generates $1 million in NOI and the total loan amount is $10 million, then the debt yield is 10%. This means that ignoring all other factors, the lender would earn 10% return on their investment from the property's income alone. Now, why do lenders care about debt yield? Well, debt yield gives lenders a pure measure of risk. Unlike loan to value, LTV, or debt service coverage ratio, DSCR, it's not influenced by appraisals or interest rates. It's just what the numbers are going to bring in for them. And here's why lenders love it. It's a really objective risk assessment. Debt yield focuses solely on the property's income, providing a clear view of the financial stability for the project. It's a market neutral metric, so it really doesn't depend on changing property values or cap rates, which makes it more consistent in volatile markets. And it's got some default recovery insight. So a higher debt yield means that lenders could recover their investment faster in a foreclosure situation. It's a regulatory benchmark. So many lenders set minimum debt yield requirements, think 8 to 10% for CRE loans. And this ensures that the property can sustain performance through downturns. And here are some typical debt yield benchmarks. So conservative lenders, think banks and life insurance companies, are generally in the 10 to 12% minimum range. So you have bridge or private lenders where 8 to 9% could be acceptable. Now, high leverage or value add projects may drop it to 7 to 8% depending on the exit plan. And debt yield requirements tightened as market uncertainty rises, which is why strong income producing properties generally attract better financing terms. So let's examine debt yield and kind of compare it to DSCR. And what's the difference between the two? So while both measures loan safety, DSCR focuses on monthly cash flow coverage, NOI divided by debt service, while debt yield focuses on overall loan exposure, so NOI divided by loan amount. Lenders use both to cross-check a deal's health, but if one metric tells the truth in turbulent times, it's the debt yield. So, the Medallion Fund's advantage is our next segment. At Medallion Funds, we understand what lenders are really looking for. Our team structures deals to meet or exceed debt yield and DSCR thresholds, giving you access to better rates, higher leverage, and faster approvals across our 600 plus lender network. And if you like, please schedule a strategy call today to see how we can optimize your next deal. You can visit my personal website, billrapponline.com. And here's the conclusion for the day. So debt yield might sound like a funky technical metric, but it's actually the heartbeat of every commercial real estate loan. By mastering it, investors and brokers alike can position their deals with confidence and speak the language lenders respect most, risk-adjusted return. And that's it for the day. Hope you have a good one.